The last example that we're going to look at for this chapter is a sensitivity analysis example. So we have a manufacturer of fragrances, and they're considering expanding their product line. They have some general information. They believe that they're going to have annual sales of 2 million units at $100 per unit. They have variable cost per unit and fixed cost per unit. The investment requires 100 million of cash outflows and has a project life of 4 years. There's no terminal disposal value, and we're assuming all cash flows occur at the end of the year. We have a required rate of return on this project of 16%, and at this time we're not going to calculate income taxes. So we're going to look what the net present value of this investment is as written, what it is at a 20% reduction in selling price, and then at a 20% increase in the variable cost per unit. So the first thing that we have to do is we have to determine what our annual cash flows are. So we have our revenues, variable costs, contribution margin, fixed costs, and our cash flows from operations. So first, at its current value, we know that we're going to have 2 million units at $100 per unit. Our variable costs are 2 million units, $50 per unit. Contribution margin, revenues minus variable costs. Our fixed costs are 18 million, and our cash flows from operations, contribution margin minus our fixed costs. So we have cash inflow from operations of 82 million. If we needed to calculate sales tax also as part of this, or to income taxes as part of this calculation, we would calculate what our income tax requirement would be on this amount, subtract it from that, and then we would add in the depreciation tax shield of this investment. Because we're ignoring the income taxes, we're not going to do that at this time. Now we need to determine what the net present value is of those flows. So we have a 4-year useful life at 16%. We're going to go back to our tables. In this case, we need an ordinary annuity, that end of year. We're going to find 16%. Doesn't up. I needed to go find a present value table that went up to 16% because that website didn't. So we're at 4 years. Our value is 2.7982. So if we go back to Excel, we take our cash flows times that factor of 2.7982. Then we're going to subtract our initial cash investment of the $100 billion. Giving us a net present value of $129,452,000. When we're looking at the sensitivity analysis, then in the second example, we would have all of this same information. We have our revenues, variable costs, contribution margin, fixed costs, cash flows from operations. But we're going to change the revenues. in this case. So we have a 20% reduction in selling price. 20% of $100 is $20. So we're going to reduce our sales price by $20 down to $80. That changes all of our numbers and gives us new cash flows from operations of $42 million, which reduces our net present value. All of the other calculations are exactly the same. The third example says, what if we just have a 20% increase in the variable cost per unit? So we're going to reset our revenues to the original amount, and now we're going to do a 20% increase on our variable cost. So 20% of $50 is $10. We're going to increase our variable cost to $60. That resets all of our calculations. It tells us that our cash flows from operations then are $62 million and gives us our net present value of the project of $73,488,400. So this is a way that you can calculate this, how sensitivity analysis changes given your net present value given different amounts of calculation.